G'day everyone, welcome to this weekly general update for the 2nd of February. And as you're aware, the correction started in America, in fact globally last week. At the moment it's been fairly mild, but then that's not unusual. So what I want to do is have a look at a couple of different patterns, a couple of different ways of looking at the S&P index, because it's the S&P that sets the tone for the world, for the sentiment of all stock markets. If the S&P index is not falling sharply, then pretty much all other stock markets and stocks can trade on their merits. And that's the key thing that we want to know, whether there is a significant sentiment change or not. So let's have a look at what happened last week. In the S&P, it ended up dropping 8 points on the week. Now, as I said, I'm going to look at a couple of different chart patterns. There is a possible head and shoulders pattern developing, which if it follows through would give us a target around about 1690-ish, somewhere of that in that sort of area. Now for that to occur, we would need a small rebound to maybe 1800 to 1810 would be pretty normal before markets then rolled over. So if that pattern is actually going to play out, then we've probably still got a little bit of a bounce to come yet. Haven't really had that. Now this is a purely technical correction in my view in America. No matter what path it actually follows, it's really not about a significant change or a significant deterioration in the US. The facts are that the US economy is moving ahead quite nicely, and certainly the latest reporting season indicates that the corporate fundamentals continue to progress quite nicely, with around about 70% of American companies beating expectations. So in 2013, the US market was up around about 30%, and that was in anticipation of the good corporate earnings coming through. Now those corporate earnings have now materialized, which means that that a lot of stocks the price rises that we saw in 2013 are justified. There are some stocks that are just stupidly overvalued. I mentioned those last week. Stocks like Netflix and Amazon are really trading at absolutely cloud cuckoo levels of valuation. But by the same token, there's a lot of stocks that are trading on quite reasonable valuations of around about 10 to 12 times earnings, when their earnings growth is of the order of 15 to 30%. So that represents pretty good value in my view. So we've got an enormous spread in America between ridiculous valuations, but also some very good valuations. But nevertheless, the economic and corporate fundamentals certainly will allow the US market to continue to move ahead throughout 2014. So let's take a look at that chart. So we'll start first of all with one way of looking at it, which is using Fibonacci retracement structures. And the bigger picture structure starts here at the last time we had any kind of significant pullback in the market, and that was in September, October of 2012. So if we take that structure from the bottom to the recent peak, and we look at a 38.2% retracement, which is as far as I would expect this to decline, given that I still think we're in a strongly uptrending bull market in 2014, then that gives us a target of around about 1658. So let's call it 1660. Now that also corresponds fairly well with this recent low here in October of 2013. I think that's about as far as the market's going to fall, because if you look at the RSI, you look at the MACDs down here, they would be significantly oversold down at that level. So I think that's probably about the bottom level. Now, as I mentioned, if there's and I'll just finish on the second Fibonacci structure, and that's the retracement of the most recent move. So we had a move here that started on the 19th of September, concluded on the 25th of September. Sorry, that's the 19th of September through to the 23rd. That's not correct. That's the 9th of October. So that's the most recent correction that we've had. So if we retraced one of those 3 Fibonacci levels, 1773 is the 38.2, and you'll notice that that's been providing support so far. Then we've got levels at 50% and levels at 61.8. So going all the way down to 1725. Those two lower levels also correspond, broadly speaking, with the 150-day moving average, which you can see the index has not broken through that level since the last correction, major correction we had in 2012. So you can expect some support around that level. So far we've had an A-leg decline to the 38.2. Hasn't really bounced very much yet, but I would expect a bit more of a deterioration to one of those two lower levels. Now, the other way of looking at this is that there's a head and shoulders pattern developing. You can see here, this is the right shoulder that developed here and peaked out in late November. We then had another rise to the recent highs around 1850, peaked out in mid-January. That's the head of the formation. And now we're working on the formation of the right shoulder, if indeed that is going to play out. Now, we don't necessarily need a bounce, but a little bit of a minor bounce up here to around, say, 810, and then rolling over, breaking through this basically this neckline through here. Let's just put a neckline through there. So once we break through that level, then roughly speaking, you can expect the height from this neckline to the peak, which is around about 60 points, and you can then extend that to the downside, which brings us down to 1690. So if that's the way that pattern is going to play out, then we can possibly expect a bit of a minor bounce this week and then a breakthrough. But of course, you don't necessarily have to have a bounce. This could just break through straight from here. And frankly, if that were to occur, if it were just to break through from here, then that would be a sign of weakness. And I think it's possible then that we're looking at the 1660 level. So this week, I think, should tell us a lot about how this correction is going to play out in America, and therefore how long and how deep it's going to be. So this week, I think, will be extremely instructive. Now, moving to the Australian market, our index ended up falling 50 points on the week. There's really very little direction in our market at the moment. It's just up and down. We're getting some sector rotation from the banking sector into materials. I think 2014 is going to be a much better year for commodity stocks than what we saw in 2013. But there's really not a lot happening. We're just going to follow what happens in the US. Now, gold dropped by $26 on the week. Gold stocks slightly outperformed the price of gold. So there's certainly some continuing positive signs there that we're on the cusp of a new bull market in gold stocks that could run for the next couple of years. However, there's one thing that I note, and that's that the price of silver is not yet outperforming gold, which is what I would be expecting to happen. In fact, the price of silver is really doing very little. So that's why I'm still just a little bit cautious. I believe we are on a medium-term view. We're right at the start of a new bull market in gold stocks, but it may not be quite underway just yet. And so another little run to the downside is possible. Now, copper eased back $3 to $3.21 a pound during the week, so just a little bit easier. And oil was steady at 97. Let's just have a look at the copper chart so you can see we got up to $3.37 a couple of weeks ago. We're back down to the $3.20 mark. Now let's just have a look at the gold charts. So first of all, this is the price of gold. So if we pan back and take a big picture look, you can see that the 150-day moving average is really starting to flatten out now. We haven't seen that for quite some time. That's been in significant decline, and the price of gold has been significantly underneath that moving average line. Now the moving average line is now flat, and the price is getting very close to breaking through. So we just need to move above this little level, which is at 1270. It had a couple of peaks above that in the last 5 or 6 trading sessions. Wasn't able to convincingly close above that level. So we've just had a little bit of rejection. But once we're above that level at 1270 on a closing basis, and ideally if we can move above the 150-day moving average, then I think we're in pretty good shape. Ultimately, we're looking for a move above 1440 would be a very powerful signal, but gold stocks would have well and truly taken off by then, so we need to position for those in the near future. This is the GDX index. You can see the 150-day moving average is the purple line and the 50-day moving average is the red line. They haven't crossed yet, but certainly better signs of basing, and both of them have also flattened out. So a bit of a turn up in this 50-day moving average would be very positive. Looking at the junior gold index, hasn't done a great deal in the last week or so, but also good signs of basing out there. So from an overall strategy point of view, I expect resource stocks and gold stocks to be the outperformers in 2014. They are more volatile, so you need to be more stringent in the way that you trade them, but I think that they will do better than other sectors of the economy. I think it's still going to be a year to buy the dips in 2014. I think that'll still be productive, but because of that added volatility, you just need to be more careful about how you do that. I'm expecting this correction to take 2 to 4 weeks to play out. That would be normal, and I don't see any signs that this correction will be anything other than a normal correction of somewhere between 5 and 10%, perhaps 12%, but I think that'd be about the most. So at this point, it's important. Positioning is important. Ensure that you're cashed up so that you can take advantage. And this is really a time for waiting. Just sit on your hands for the time being, and the opportunities are going to present themselves. For anyone that would like some more input or assistance with their trading, please feel free to contact me. There's my email address. Happy to talk to people who genuinely wish to improve their trading performance. And I think we're looking at 2014 as being a pretty good year. That's it for this weekend's update. Cheers.